Hello and welcome to today's video. I am Sarvesh Gutti, founder of Auris Wealth. We are your long-term wealth partner. In today's video, I am going to discuss about four mistakes that a lot of investors are making in their investment journey and how you should avoid making those particular mistakes. And if you avoid those mistakes, what can be the result of that in the long run? Okay. Before starting the video, if you are an investor in any of these products, whether it be mutual fund, SIF, PMS, AIF, or gift city funds, or you want insurance guidance, then Auris Wealth can help you in your and your family's total investment. We give you recommendations of products and funds based on our deep research of more than 4,000 funds and also help you to organize your investments, your finances, your wealth, and do 6 months and 1 year portfolio review and rebalancing for you so that you and your family will be able to achieve your financial goals on your time of target. Okay, so if you are confused about where to invest, how much to invest, which fund to choose, when to switch the fund, etc., and you have a decent amount of capital, let's say about 10 lakh rupees investment surplus, existing capital, or you want to invest more than 10 lakh rupees, then you can connect with us for a free investment guidance and discussion call. So visit auriswealth.com. The link is in the description box below. Okay, so let's understand the four mistakes that a lot of investors are making. First mistake that I see a lot of investors who are investing through DIY platforms, through direct mutual funds, is that they are just chasing returns of the past 1 year, 2 year, 3 year top performing fund, expecting that that particular fund is going to keep on giving the same kind of return even in the next 2, 3, or 4 years. Okay, and recently I came across a person who is around 29 years old and he has around 2 lakh rupees per month salary and he has accumulated good savings of around 21 lakh rupees over the last couple of years, and he was getting a portfolio CAGR of around 11.6%. Now he was complaining that in last 2 years the market has not given any return, and he had invested in gold funds when gold was going up. He had invested in classic uh, funds which were doing in good in last 2 3 years like Parag Parek, etc. And nothing wrong in that particular fund, but he purely bought those funds simply assuming that those funds will be top performer for next 3 4 5 years, and now he is disappointed that those funds have not given that kind of return. So I asked him simple question: what is the purpose of you investing in these top four funds? You just give me the purpose. And the answer was very clear, that just because those funds had given good performance in last 2 years, he thought that these funds are great funds, they are the best funds, and he should invest in them so that he will continue to get that kind of high returns in the future as well. So this is the biggest mistake that a lot of investors are doing, thinking that they are doing research on a DIY platform just by looking at past 2 years, 3 years, or 5 years top performing fund and investing in that fund. So this is not research. This is purely called as return chasing. And if you do return chasing, you are not going to do a proper investment. Eventually, you will find that every 2 years, every 3 years, you get disappointed that the past performing funds are no more the top performing and some other 2 3 funds have become top performing and you missed out on that opportunity. Okay, so what is the solution for this? The solution for this is not to chase past return, but to have a proper asset allocation and a proper reason for why you are investing in a particular fund. Okay, if you have clarity of why you are investing in that fund, what is the role that that particular fund is going to have in your overall portfolio, then only it makes sense to invest in that fund. or else you need to skip the fund. Okay. Second mistake that I'm seeing a lot of investors who are doing investing by themselves is that they do not have any kind of portfolio process or investment process. They are just investing randomly. Once they have some extra money, then they invest in the fund, and eventually what happens is they collect 10, 15, 20. I have seen portfolios where they have almost 37 different funds in their portfolio, and there was 66% portfolio overlap, which means that this person had invested almost 6 7 flexi cap, 6 7 multi cap, 3 4 balanced advantage fund, and there was kind of a khichdi that he had made in his portfolio, and he, in his mind, he was thinking that he is diversified, but actually what he was doing is just multiplying the holdings that he already had, which is called as portfolio duplication, right? So there is no investment process that most of the people are following. They're just doing random investment, and whatever is your random input, you can obviously expect the output also to be random. So hence the returns are also random. Some years the returns are very good, then suddenly in 2 3 years the return become less, then they panic and they start selling, and they believe that mutual fund and all are not giving any return. Then they look for some other investment product, and by the time the market recovers, they feel that they have missed out on the opportunity, and they come back at the top of the market and reinvest in the mutual fund. Okay, so this entire exercise is happening purely because of lack of investment process. So how to solve this? We at Auris Wealth have a clear defined process for helping our clients to invest in various asset categories, whether it be mutual fund, SIF, PMS, AIF, or gift city funds. We follow our investment process based on our research, based on risk management, and based on the portfolio construction logic for every particular client. And it is all having a foundation of client to client. What is the client's objective, what are the client's goals, and what is the risk appetite that they have, and what is the time horizon that they want to invest. Okay, so this is the second mistake. Third mistake is that clients, investors who are doing DIY investing, that they do not have any kind of exit strategy. So whenever we start investing for our clients at Auris Wealth, we have a clear, defined entry strategy of why we are entering a fund, and we have a clear, defined exit strategy, which means that at the time of buying the fund, we know in which conditions we are going to sell that particular fund. Okay, so that condition can be based on time, based on risk, it can be based on some other factors like fund manager got changed, or the asset allocation of the fund changed, or the fund was more conservative earlier, now they have become more aggressive. So there are multiple factors on which we decide that if any of these factor changes, then only we will exit that particular fund, or else we will continue to stay invested in that fund. Second thing that we do is we make sure that there is a date till which we will hold the fund irrespective of the performance of that fund. So let's say right now it is August 2026. There is a client who wants to invest 30 lakh rupees, and we created a portfolio allocation for the client, and the client then gave us the go ahead, and based on the client's risk appetite, objectives, time horizon, we suggested the client, let's say, 5 funds. The client also agreed on those funds, and now those 5 funds, every single fund will have a goal for which goal we have invested in that fund, and every single fund will have a target date of holding, which means that, let's say, August 2026 to August 2031. So for 5 years we will hold this particular fund irrespective of the return of the fund. If the return is great, good. If the return is not good, then also we'll at least stay invested in that fund for 5 years till August 2031. What this gives us is, this gives us a discipline of staying invested in the mutual fund irrespective of the market cycle. And data has proved time and again that whether it be any asset category or very product vehicle, whether mutual fund, SIF, PMS, AIF, etc., the longer you stay invested, the longer you go through the bull market, bear market phase, the longer you are going to get the benefit of compounding, and most of the times you will find the returns will also be much higher if you stay invested for a longer duration of time. Okay, so what this does is it gives us a clear idea of when we will exit the fund based on target and based on multiple other factors that is predefined even before entering that particular investment. Okay, fourth mistake that a lot of people are doing is that they are comparing their returns with somebody else's returns. Okay, there are a lot of people who come to us, not Auris Wealth clients, but the clients who are potential clients of Auris Wealth who are thinking of starting to work with us. They come and say that I got 13% CAGR and my friend got 15% CAGR, and I don't like that advisor who was advising me, or if they are doing investing by themselves, they feel that they are doing something wrong. That is why their friend is making more return and they are making less return. Okay, so here the lesson to learn over here is every person's portfolio is different. Every person's risk appetite, investment goal, investment objective, time horizon, volatility, the ability to go through volatility is very, very different for every single person. Okay, there might be a person who is having just 10 lakh rupees portfolio, but the risk taking ability is very less. But there is some person who has 5 crores portfolio, his risk taking ability or his ability to go through volatility might be much higher than the 10 lakh rupees portfolio holder. Okay, the time horizon of two people might be completely different, and based on that the portfolio is constructed for every particular individual. Now, it is obvious that the person who is having a less ability to go through volatility and go through risk taking capacity, less risk taking capacity, will have a conservative portfolio. And then there is somebody who is having a growth mindset, higher time horizon, let's say 10, 15, 20 years of investment period, more equity allocation, and a higher appetite to go through volatility. That person's return over 7, 8 years or 10 years will be obviously higher than the return of the person who is having a conservative portfolio allocation. That is obvious. So the conservative investor is expecting that he or she will get highest return, but they want lowest volatility. That is not possible. But there are many people who are doing investing by themselves just by comparing somebody else's returns. So they say, my friend got great returns in gold, great returns in small and mid cap category in last 3 years. I missed out on that opportunity. Now I'm going to be smart. I'm going to invest all of my money in small and mid cap funds. And eventually what happens? Eventually that entire phase of bull market in small and mid cap ends. This person is invested at the top of the market. Eventually the market corrects by 20-30%. That person loses patience and loses the capital also, and eventually exits at loss. So you should never ever compare your returns with somebody else's returns, because your risk appetite can be different, your ability to go through volatility can be different, your objectives can be different, your time horizons can be different from the person next to you, and they can, who knows, they might be taking extreme risk just to make 2-3% extra CAGR return. Okay, and they might if the market turns around and there is a correction, they might lose 50% of their portfolio in next 1 year, but your portfolio will correct maybe only 10%. But he is taking so much extra risk just for 2%, 3% extra CAGR. So you don't know what the kind of risk they are taking and what kind of concentration bets that they are taking. So you should never ever compare your returns with somebody else. And the solution for this is to have proper expectation. Expectation comes from having a proper investment process, and the investment process involves having proper asset allocation, proper risk management, and proper rebalancing and portfolio review schedule. Okay, so if you avoid these four mistakes, automatically you will be amongst the top 10% of investors in India, because 90% of the investors are still continuing to do these mistakes and will continue to do these mistakes even in the next 10, 15, 20 years, because this is the normal behavior of an investor, whether it did be in India or anywhere across the world. So make sure that you avoid these mistakes. Now, as individuals, you might be doing some job, you might be doing some business which is uncorrelated to the investment field. So you need a professional who will help you to navigate this complex world of financial markets, of investing, of insurance, of succession planning, of taxation, etc. And to make sure that you don't do any costly mistakes in your wealth creation journey just to save 0.5%, 1% expense ratio per year. I have seen many people who are said 1% expense ratio, but they have made mistakes which have costed them 5%, 6% CAGR over 5-6 years period. Okay, so you have to become smart. You have to think for yourself. Is it worth to pay 1% extra expense ratio to a mutual fund distributor who will give you professional guidance not only for your investments but also for your insurance, tax also, as well as succession planning like will creation, estate planning, as well as HUF creation, trust creation, etc. And having a organized, structured finances and wealth in one central place with proper 6 months portfolio review, or you want to just continue and be like the remaining 90-95% people who are just going to struggle in their way of wealth creation journey. So if you want to be in the top 5% of investors having a professional approach and professional system to help you guide in your wealth creation journey, then you should definitely have an initial discussion with us. This is no charges, no obligation. If you feel after the discussion that Auris Wealth is not the right wealth partner for you, it is absolutely fine. If we feel that we will not be the right wealth partner, you might not be the best client for us, we will also tell you, because we believe that we are going to be a wealth partner for not just an individual but for the family for next 10, 15, 20, 25 years. So for that, our wavelength, our thought process has to match. So book a free initial introductory discussion call with us. The link to booking this particular discussion call and introduction call is in the description box in the first pinned comment of this video. And if you like this video and you want more such informative videos about personal finance, investing, etc., then do subscribe to our channel. Hit the like icon, which will help us to reach more people, and also share your thoughts in the comment section as well. Thank you so much for giving your time, and I will see you in the introduction call with us. Okay, so make sure you book that. Link is in the description box below, and I'll see you in the next video as well. Thank you so much. Goodbye.